Hi, this is Randy Finney with the Right Side of the Chart, and it is Tuesday, October 18th, 2016. I'm starting this video at 11:21 Eastern Time, and we're going to take a look at what I would have to say right now is one of my favorite sectors. And I'm going to go over some of the individual stocks in that sector, starting out with the ETF. I know some of you prefer to trade ETFs for the relative diversity and safety. You don't have as much risk as a gap going against your position, especially as we head into earnings seasons here. That being said, my preference typically is to go with the individual stocks. If I find a bullish or bearish sector, I like to drill down and then find the most bullish or bearish setups within that sector. And I also do that. I go through these individual stocks um, not just to find individual stock setups, but also to confirm the nature of the charts. In other words, I'm going to start out here looking at IHI, which is the iShares Dow Jones U.S. Medical Device Index Fund ETF. That's a mouthful. So these are medical device stocks, and we're looking at the ETF. I'll make a case on this, looking at a few different time frames, and I won't go through all the components. There's actually a ton of medical device equipment stocks, so I'm only going to go through some of the larger, more liquid names. And it's funny, as I started doing this today, a few days ago, some of these stocks started coming on my radar, and I haven't looked at the entire sector until today. But as I was going down the list, I honestly had a hard time finding a single chart that I didn't like, that didn't look like a nice clean bearish setup. And when I say clean, I'm talking about well-defined technical levels, support, target levels. Some stocks and some sectors tend to trade to the technicals better than others. And so when I say, clean charts, that's what I'm referring to. So let's just go ahead and dig in here. And before we get going, I'll make mention that, I will be putting out some of the individual trade ideas. Who knows? Probably no more than half a dozen, and as well as the ETF. So if you plan to put exposure to the sector, I plan to have an overweight exposure to this sector. If and when these charts trigger, I'll go over that today. I'll tell you what the entry points are. At that point, when I say an overweight exposure, uh, it, it, I'll never put all my eggs in one basket, nor will I put almost all my eggs in one basket, meaning not just any one stock, any one sector. It's financial suicide, trading suicide. If you're a gold bug and you have all your money in GDX and gold related stocks, or whatever your sector is, technology, you name it, if you have, all or most of your portfolio in that sector, yeah, sure, the run is great when it goes for or against your position, but you can get wiped out. And I promise you, over time, nobody's right all the time. If you don't properly manage your portfolio by diversifying among various sectors, various stocks. Ideally, I like to trade long and short. At times I'm more short than long, more long than short. Different asset classes, that don't have a lot of correlation. For example, gold, fixed income, U.S. stocks, international stocks, etc. So you get the point. So if and when you like this sector and you decide to add exposure, just keep in mind additional trades will be coming. So you need to sit there and calculate ahead of time, what type of exposure do I want in this sector? Do I want 10% of my portfolio, 20% of my portfolio, and then leave room to add individual stocks or additional trade ideas as they come out. All right, let's dive into the charts now. IHI, this is a daily chart, and you see a nice clean uptrend line, well-defined reactions here, 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 here. You had a double negative divergence. You had a divergent high at this point. And a lot like the broad markets and a lot of things out there, this market's not going any higher, but it's also refusing to really roll over so far. So what happens is the medical device stocks pretty much peaked back about a month or so ago. It looks like early August, and have since just put in a marginal new high. Now that marginal new high, as this line indicates, was a divergent high, very steep divergence. So the second negative divergence was much more powerful. So again, this is just consecutive negative, or what I call double negative divergence. You had a pretty well-defined uptrend line there, an impulsive breakdown, as you can see. By impulsive, I'm talking about the big red candlestick on high volume right here. That helps to confirm or validate that this trend line was a key technical level. And I mean, you can just look at all the reactions on it most recently. So there's your breakdown. And, that puts this sector on a sell signal. However, as I always say, trade anything you're trading sector-wise. Keep the broad markets, especially if something trades in line with the markets, as the medical device stocks more or less do. They're, a subcomponent of the healthcare sector. I'm talking about those flashpoints recently on the broad market, some key support levels, those recent trading ranges, the bottom of the trading ranges the markets have been in. Those need to go, as does this 139.26 level, to really get the next wave of selling going here. So what happened? Again, we've broken down. That is bearish. However, there's pretty decent support both in this sector as well as the broad market. So there's a level to watch. Roughly 139.26. If and when that goes, it is very thin, meaning not a lot of trades, and I would expect, again, assuming the broad markets confirm, a quick drop down to 135.55, and at very minimum, my swing target here is 127.35, and that represents a drop of about 10% from current levels, 10.25%. And again, that's the ETF. I can make a case for much larger gains on some individual stocks. Take a quick look at the weekly chart. This goes back, shows your this is what I refer to as a primary bull market uptrend line. This goes back off, I used the lows back in late 2008. Like a lot of stocks, there was an overreaction, a sort of a meltdown, a very quick overshoot and reversal back on the lows in March. And when drawing trend lines, I'll do this. If you want to see the highest quantity of reactions. Those are candlestick bodies and or tails, wicks, these shadows. And I think this is a very well-defined trend line. At the very least, even if the bull market isn't over in the medical device stocks, which I, believe, looking at the fact we're, what is this going on? Almost 7 years into a bull market, which is at the very long end of historical bull market runs. We probably are very at or near a top. And even if we're not, at the very least, at this point in time, I'm just looking for a reversion to the mean. What I'm talking about is we haven't visited this trend line since back in February of this year. And if you look at these overbought readings, when you see these extreme overbought readings on the RSI, as you see here, let's circle these. You can see it up here. What happened up here. So when we get away from that trend line and you have these overbought readings, you often come back, again, a mean reversion back to that trend line. And that also corresponds roughly with that support level that I'm talking about. That's that line, I believe, that I had set for about a 10% pullback, the minimum target. And I wouldn't be surprised to see us overshoot that. And again, it depends if and when this sector does start correcting soon, how long it takes to get there. So what I mean by that is if the market has a slow rollover, it could take, quite a while, and then you would see those lines come in together if and when prices got there. I don't expect that. Markets usually drop, and stocks drop much faster than they rise when they get going up. You can see that. Usually you wipe out weeks or months of gains in just days or weeks. That's typically how things work in the market. So my expectation is more of a pretty quick move down, and I think the charts are going to confirm that. So what we'll jump in, and I'm not going to go through them all, just look at some of my favorites here. Let me go to have a related items here. Here's all the different medical device stocks, and I've just flagged a handful of those. Let me make sure I have these sorted by flags. Yeah, there we go. Okay, first one up is MDT, and I'm going through these in order of market cap. I may jump around a little bit. We're on a weekly chart, so I'll just stay there. So what do I see here? I see a beautiful ascending price channel. You can see the yellow lines define this ascending price channel. We broke down, very impulsive breakdown back in 2015. We back tested it once, pulled back tested it again, and have rolled off the bottom of that channel. Again, I'm looking at this yellow trend line. This second back test happened to coincide with a very powerful divergent high. This white trend line here with prices making a higher high in MDT. This is Medtronic. You can see on the PPO as well as the RSI that that was a divergent high. And now you have this really what you can call a sub channel or this minor uptrend line, and prices have started to crack below. So that's a weekly chart that paints the bigger picture. When we zoom down to the daily chart, we take a look here, and you can see that the stock is dancing on support right now. We have support around 82.68 there. A little gap, little brief shot down below that level, but I can see a couple reactions there, some reactions here recently. Looks pretty thin too. I look at the volume at price histogram, these green and red bars, and this is a solid support shelf, which I also view as like a magnet. So if this level breaks, which I expect it will, I think you'll see a pretty quick drop down to that next level, and that's that's good for a little bit better than a 4% drop on Medtronic. That target there is 79. The support level's at 79.08. And if and when that goes, then we probably head down here. Next key support is 73.17, which is, just try to quantify it for you, about almost a 12% drop. So that's MDT. Not one of my favorites, but one that stands out. Next one up, ABT. This is Abbott Labs. This one, let's see, the daily chart here is a mess. And you know what? I had an asterisk by it, meaning it's not one that I'm going to put as a trade idea, but I did want to point out what's gone on, and this really helps to confirm the bearish stance on the sector, the bearish outlook on the sector. You know, this is a 10-year weekly chart we're on now. You can see it had a nice downtrend line, strong basing pattern. It broke out of that and it's had a heck of a bull run. You know, just really since the 2009 lows, this stock has gained, 154%. So a heck of a run. And as you can see, it had a very well-defined uptrend line coming here off the 2011 lows. And we broke down below there, back tested. This has been a resistance level. So this was your bull market trend. And since then, this stock has been in a clear downtrend. Once it topped out here, it had a very powerful divergent high at that point. Now it's chopping around so much, it's sort of alleviated a lot of those overbought conditions. So again, I won't spend too much time, not one of my favorites, but the point I'm trying to impress as it appears that, the bull run in these stocks have ended. And the next one up I have would be, let's look at Stryker, SYK, Stryker Corp. We're on a weekly time frame here again. Also what stands out, as I mentioned on the ETF itself, you can see these extreme overbought readings well above the 70 level, almost up to the 80 level on the RSI. Very rare to see these. This is a 10-year weekly chart. So we've only seen such extreme readings as we have right now, or most recently, in the last decade plus, going back even further to the left of this chart. We've only seen that twice. So what happened the last time we had such an overbought reading? We had this huge drop. And as I said, once these things break, you usually get these waterfall sell-offs. So what would that correlate to? Well, let's just say that back then, that was good for a drop of 32, almost 33%. And remember, this was early in a bull market, just a couple years into a healthy, young bull market, and that's what happened. Now we are very extended in a very aging bull market. So it could easily drop that much or more. From the highs, that's looking like 23%. And again, at the very least, my expectation is a reversion to the mean. In other words, to revisit this trend line, which we haven't visited since back in 2012, early 2013 was the last time we touched that bull market uptrend line. So just from there, where we're at right now, you're still talking, depending on where we hit it, you're talking about, let's just say, anywhere from 18 to 16% would be my expected drop. And again, I can't impress enough, that would be my minimum target, because if that primary bull market uptrend line goes, we're probably heading down here to 80, 86 and change. The stock's at 114 now, so that's about a 25% drop. And before all is said and done, I could easily see us going down here to the $78 level, which is about a 32% drop. So a lot of potential on these names. Let's look at the daily chart. You had a downtrend here, breakout, rising wedge pattern. That rising wedge pattern had some divergence on the RSI, pretty much flatline divergence. It didn't have divergence on the MACD. The MACD put in a slightly higher high, but it still played out for a healthy correction so far. And these are the levels to watch. These are support levels here around 112.38 and then 110.11. So we need those to break. And again, this would be more of a play on a weekly chart. And you know, it may or may not make it up as an official trade idea because I need to see very clean, objective entries, and this one's a little tough on the entry. Where to, in other words, where to enter a short position, and then where to place your stops. Let's go on to the next one, which would be, let's see if I have the, yes, BSX, Boston Scientific, big name in the industry. And again, I'm going through these in order of market cap. So these are your bigger mega caps. A lot of liquidity in these stocks. And you can see just a very clean bearish rising wedge pattern, very steep divergence, confirming that bearish rising wedge pattern. It broke down, but again, the sector hasn't really had a hard meltdown because the broad market's holding up. So everything's sort of traded sideways. It has moved lower, don't get me wrong, since the highs. If I can grab them or at least come close to those. You know, this stock's already down about almost 8%. However, it has a couple support levels it needs to take out, and it's starting to. It has support right about here, which it just cracked. This one might offer an objective entry now. What I like about it, if you take a look down, my the MACD is trending in bearish territory. We have the MACD and both the MACD line and the 9 EMA below the zero line. That tends to indicate the trend is down throughout the last few years. The stock has been trending up, so you can see the MACD was above that zero line. That's that dotted line right here, zero line. So a clean looking chart, and this one has a lot of meat on the bone. You can look at these targets. I expect to move down here. Probably a reaction at that point because that's the top of a very big gap that you can just make out right here. See this big gap? Oops, wrong tool. Let's try to. Having a hard time with these drawing tools. There's your big gap. So again, to draw it out, I think this one looks something like this. Move down, little reaction at the top of the gap, and then boom, a gap backfill. And that would be good from this level here. I may even take a starter position in this one here soon. That's about a 14% drop. I think that's very doable. And it may even take out the bottom of that gap. There's some nice horizontal price support right there around $19. That would be a nice long-term swing target, good for almost an 18% drop on BSX. And if I didn't cover it already, here's the weekly chart. There's the story on that one. Nice, clean primary uptrend line, which if everything I just pointed out on the daily chart plays out, what that does, it takes this bearish rising wedge, this powerful, on the weekly chart, this powerful bearish rising wedge, confirm with negative divergence, and then that pattern breaks down, and that would most likely bring that stock down. I mean, possibly as far down here as the $14 level in time, but at the very least, this is a very solid and high probability target around 1880 or so. And that's BSX. Okay, next up, really like this one too, ISRG. This will probably make it on as an official trade idea. Nice, clean, bearish rising wedge pattern, confirmed with negative divergences. Some well-defined support levels. There's a target here around ballpark number 668. When that goes 647, then a move down to 610.13, which I would put as a high probability or my preferred swing target right now. So, those little zigs and zags along the way. And then ultimately, again, depending on what the broad market does and what this sector does, you might get a move all the way down here to that 560-ish level. Again, pretty clear chart. Obviously, a break below that bearish rising wedge pattern would be the most objective entry. Let's take a quick look at the weekly chart. Here's ISRG on a weekly chart. There was a uptrend line. You could draw this uptrend line several different ways, but there's a key support level. This one this was an old, that actually goes way to the left of the chart. I haven't updated this weekly chart in a while. Let's get rid of that trend line and just put another one here and kind of show you what happened with this stock back here. All right, you had negative divergence back then in 2012, and more importantly, you have these crazy overbought, extreme overbought readings that you can see, just as we have now. Actually, this one's quite extended, just as overbought, very extended. And again, history tends to repeat, and that's what technical analysis is all about: identifying past patterns and what prices did following such similar technicals. And you can see, these are big drops. I'm using log scaling on this chart, so these drops are probably measuring 20, 30+%, and I see no reason why that's not going to happen again. So there's a minor uptrend line to watch for a break of. There's the primary uptrend line, and again, that's already covered here on the daily chart. So there's your targets. All right. Couple more to cover and we'll wrap up. This is ZBH, Zimmer Biomet Holdings. A lot of lines here. What you can see is a steep bearish rising wedge pattern right here. That didn't even have divergence. Actually, it did. I should take that back to be more accurate. There was the divergence, negative divergence at the high of that wedge. You'd have to put a white line here. You can see it just right over there on the RSI. So right at the top of that wedge, it had divergence. This is the measured target of a wedge. You take the widest part of a wedge, add it to the point of the breakdown. So you can see that one pretty much hit its target, fell just a hair shy of the measured target, but it also, that was a support level. Had I been in the stock short at the time, I would have certainly had a target right here. You can see how well defined this level is. There's a gap there. Reactions from above and below, and this is still a long-term target for me. That's 114.70. So zooming in or talking about what's happened to the stock since then, it went on, pushed up, made another divergent high, a second consecutive divergent high up at this point. Follow the vertical line straight up on the crosshairs and down to the RSI and the MACD, and then yet another divergent high. This is a double top. These were equal highs, but you had a very steep decline, considerably lower lows or lower highs in the MACD and RSI. So there it is, 3 consecutive or one really large divergent top. And this is a trend line to watch. Next sell signal on this one comes on a break below this white trend line. I put these yellow minor uptrend lines here. Each break has resulted in a pullback or a correction, but to get the big move here, we need to see a break of this line, which I'm going to set an alert right now before I forget. And then this would obviously be your first target here, unadjusted for a fill. The actual support level is 122.55. And again, I think this one has a very good shot of going down to at least this 114.70 level. Here's your weekly chart. There's a primary uptrend line which was broken. This one went in to put a marginal new high, and I don't think I covered this one yet on the weekly time frame. So you can see, same story. These crazy or these overbought readings on the weekly time frame often result in very powerful corrections, very tradable, swing tradable corrections, meaning you can position for weeks, if not months, usually months on these. And that's CBH. Next up, EW Edwards Life Sciences. I was on a weekly time frame, so we'll start this one on the weekly time frame. The usual story. This was back in early in the bull market. You had divergence only on the RSI at that point, but it still led to a healthy correction. Stock kind of floundered around for a couple years and has a very similar, nearly identical uptrend line, identical in both slope and duration. And you can see this time around you have clear negative divergence on both the weekly PPO and the RSI. Targets are well defined. You have a big gap here. So the bottom of that gap, that's about 90, 95. So call it $91. That would be a first target, very high probability target in my opinion. My preferred swing target, I think this one has a very good shot of moving down to this $63 level. And, take a few months to get there. Almost certainly, but that's where I see it going. Daily chart confirms the weekly chart. You have a very nice, clean, bearish rising wedge pattern, confirmed with negative divergence. You're looking at a possible bearish crossover on the MACD right here. Should prices move much lower. So there are the divergences, and here's that level, 112.27. That's your big number right there. I like that because, as I often talk about, some of my favorite trades are when you have intersecting support or resistance levels, and a stock takes those out at the same time. So in this case, for a short trade setup, you have intersecting support at both this uptrend line as well as at 112.27 level. So the trigger on that one and this one will almost certainly become an official trade, and I'll most likely take this one. Might even take a starter position now. My confidence is high enough that, you know, sooner than later this sector breaks out. There's a little gap to be backfilled there, so you could catch some support on that gap backfill. And maybe, I think, best case scenario, if it does break down, maybe it wants to go in and do a back test, you know, come down here, backfill that gap, back test, and then move down. So, you know, there's a lot of ways to trade these. And again, the charts, I always say, the charts are dynamic, not static, meaning they change. So you watch this chart, you watch the ETF, the sector itself, you watch the broad markets, and that will often help you determine whether or not this one is likely to backtest or just break down and have a waterfall sell-off. I should have added another target level here. You have a reaction right there. That could certainly be a price target, but ultimately I expect a full backfill of this big gap back here from April of this year. That level's 89.71, so I'd have a price target, final price target, a little bit above that, and that was EW. Okay, last one, we'll wrap it up. This is VAR, Varian Medical Systems, and this one looks like this is a weekly chart we're looking at here. Same story. It needs to, at the very least, revisit. It's time for mean reversion or a visit to this uptrend line here that goes all the way back to 2009. We haven't visited that in a while. We recently reached an overbought reading on the weekly chart here, as you can see. Overbought here, just as we were overbought here at this time when we came back and revisited. We were overbought here. We didn't revisit the trend line, but we definitely had a tradable correction at that point, and we were very overbought here and here. In both cases, those very overbought readings resulted in very big, powerful, very profitable corrections on the short side, and I expect nothing less than a revisit of that primary trend line in the coming months. This is a daily chart to help time your entries. This one already broke down from a very steep and clean rising wedge. By clean, you can see the negative divergences confirming it, multiple tags on the trend line. The breakdown was impulsive, everything you want to see. Stock caught support where it should have, at least had you know, I always say the initial tag of support or resistance from above or below often produces a reaction. This was definitely a support level. You can see these previous highs back from 2015, as well as when you zoom in, you can see how that level has acted. It was resistance from below, and then we broke above it, then it gapped back below, resistance again, punched above it, and now it's support. So your next sell signal is either a break below that. Well, that's your next technically your next sell signal is a break below that level, and that level is roughly 95.50. However, should it bounce much more, and it's fact, it's got a little gap right here, so it's really bounced back into resistance. I'll probably nibble on this one, take a starter position here, because I can see resistance there. And again, the all-in for this sector, not meaning I put all my money in this entire sector, but my full allotment of how much I want to allocate to this sector will be when the sector itself, what was that, IEI, I think on the, oh no, I got to medical devices, forgot the name of the ETF, medical device index fund, IHI, there it is. Again, we need to see these levels go, and most importantly, the broad market, because until the broad market breaks out of those multi-month trading ranges, it's just more of this slop and chop, and I know that's very frustrating for swing traders, both long and short, because the market's going nowhere, and it leads to, you know, increased runs on your stops. Swing trades have a harder chance of hitting their price targets. So, you know, I continue to try to focus on trades and stocks that aren't highly correlated with the market. But with that being said, I'm putting the trade ideas out there now, because any day now we can break out of that range, and you know, I want to get these trade ideas out to you now so you can look at them and set price alerts, replicate the charts on your own, and be ready to pull the trigger if and when the fireworks start. Okay, this has been Randy Finney with the right side of the chart. Hope you enjoyed it, and if you did, if you'd give a thumbs up on the YouTube page, I'd appreciate it.